Welcome to The Explainer. Today, we're going to break down the absolute chaos that was February 5th, 2026, by looking at reports from PhilStockWorld and the AGI Roundtable. It was a single day that was really defined by one truly shocking number. Let's get right into it. $185 billion. That was the number. The high end of the capital expenditure plan Alphabet announced for 2026. A figure so massive, so completely eye-watering, that it sent what analysts at the AGI Roundtable called a wave of sticker shock, ripping through Wall Street before the market even opened. And that sticker shock, it forced a really simple but kind of brutal question on every single trader, a question we saw echoed in the PhilStockWorld chat rooms. Is this insane level of spending a sign of incredible confidence in the future of AI, or is it just a sign of pure, unadulterated panic? And this is where things get really interesting, because the market basically split right down the middle. You had the bulls, who saw this as a necessary investment to lock down future AI-driven growth. But the bears, they saw a plan that would literally eat up all of Alphabet's projected profits for the entire year. The AGI Roundtable called it the cost of reality shock, this collision between digital dreams and hard physical limits. And that set the stage for the day's entire battle. And that battle? Well, the first shots were fired almost immediately, as the boundless promise of AI ran smack into the cold, hard limits of the physical world. Yeah, this wasn't some software bug. This was about physical stuff, a supply chain breakdown. And right at the center of it all, the chip giant Qualcomm. So get this, Qualcomm posts record revenue. A fantastic quarter by any normal measure. But did it matter? Nope. The stock absolutely tanked, all because their guidance for the next quarter was weak. And the reason why was stunning. They said point blank they literally could not get enough memory chips. It was this crazy admission that the real bottleneck for AI wasn't talent or ideas, it was basic parts. And analysts immediately realized this wasn't a quick fix. The timeline for this hardware crunch just got extended all the way out to 2028. Okay, so the hardware guys were running out of parts. You'd think the software companies would be safe, right? Wrong. They were facing a much scarier, more existential threat. A threat so big it got its own spooky name, the SaaS apocalypse. And look, this SaaS apocalypse wasn't just about a new app coming out. It was this creeping fear of total, complete obsolescence. You had new AI tools like Anthropic's Claude Coware coming out, which could automate huge chunks of legal and financial work. And that's sent a real chill through the entire software as a service, or SaaS, industry. And this quote right here, this captures that core fear perfectly. The very AI that was supposed to help software companies, well, it suddenly looked like it was coming to replace them, lock, stock, and barrel. And that feeling drove a historic sell-off in a sector that, honestly, had seemed pretty much invincible until then. But here's the thing. As investors were fleeing all this perceived risk in tech, their money didn't just evaporate, it rotated. It packed its bags and moved into a completely different, and let's say much more tangible, neighborhood. And you can see that shift crystal clear in this chart from the AGI Roundtable's analysis. Look at this, the Magnificent 7 tech stocks, basically flat for January. But the money? It was pouring into energy and materials, actual stuff. It was a massive flight from digital promises to physical reality. So you've got these very specific fears in tech. The hardware crunch, the sauce apocalypse. And then, as if that wasn't enough, a whole wave of really troubling economic news just poured gasoline on the fire, turning what started as a rotation into a full-on market rout. The warning signs were flashing bright red, and you just couldn't ignore them. Job cuts, the highest January numbers since the financial crisis in 2009. Jobless claims, way, way higher than anyone expected. And then you see Bitcoin, which is a huge barometer for risk appetite, just fall right through the floor at $70,000. It was clear a deep risk-off feeling was taking over everywhere. And here's the damage. By the end of the day, everything was deep in the red. The Nasdaq, which is home to all this tech anxiety, it led the charge downwards. And the markets closed right near their absolute lows for the day. Just a really, really ugly finish. But believe it or not, the day's biggest shock, the one number that would put everything, including Alphabet spending, into a terrifying new light, that was still to come. And it dropped just moments after the closing bell. So the market's bleeding out, sentiment is just in the gutter, and everyone's eyes turn to the last big tech giant left to report its earnings. The question on every single trader's mind was simple. Could Amazon save the day? Could they turn this thing around and end a horrible week on a high note? Could they restore some faith in the whole tech story? The answer? A big, fat no. Instead, Amazon dropped its own bombshell. $200 billion. They didn't just match what Alphabet was spending, they blew right past it. And just like that, the combined 2026 capital expenditure plan for just 4 companies, Alphabet, Amazon, Meta, and Microsoft, hit a mind-boggling $650 billion. This was it, the true cost of the AI arms race, laid bare for everyone to see. And this question, pulled right from a PhilStockWorld member's comment right after that Amazon report hit, it just perfectly sums up the fear that drove the whole day. Are these companies actually building the future? Or are they just building a $500 billion monument to their own fear of getting left behind?